So you put it on the card. You told yourself you would pay it off over the next couple of months. You have a credit card in your wallet right now, maybe 2, maybe 3. And every single month you pay your bill, move on with your life, and never really think twice about it. You see the balance, you see the minimum payment, you pay something, and you carry on. It feels normal because it is normal. Almost everyone does it. Almost everyone has always done it. But here is what the company that issued you that card knows and what they are absolutely counting on you, never sitting down and actually working out. The average American credit card holder pays over $1,000 every single year in interest alone. Not the things they bought, not the groceries, the fuel, the household bills, the occasional meal out, or the birthday present they needed last minute. Just the interest. Just the cost of having used the money in the first place. $1,000 a year leaving your household and going directly into the accounts of a financial institution. And that is just the average. Millions of people are paying considerably more. And the system that produces those numbers was not designed by accident or negligence. It was engineered deliberately, tested carefully, refined over decades, and perfected into something that extracts the maximum possible amount of money from the maximum possible number of people, while making sure that at no point does anything feel urgent or obviously wrong enough to make you stop and demand an explanation. Think about the last time you went to the supermarket and spent $200 on the weekly shop. You tapped your card, picked up your bags, and drove home. Simple, normal, unremarkable. But if that $200 sat on your credit card balance and you paid only the minimum every month, that one supermarket trip would cost you somewhere close to $500 by the time it was fully paid off. Same groceries, same bags, same drive home. Almost 2.5 times the price. And the entire experience of paying for it would feel completely normal every single month, because nothing about a minimum payment ever feels like a crisis. Nothing triggers an alarm. Nothing tells you that the tin of beans you bought 3 years ago is still on your credit card statement generating interest every single day. Or think about Christmas. The average American household spends approximately $1,000 on Christmas every year. Gifts, food, travel, decorations, the school nativity costume your child needed at 48 hours notice. Most of that goes on a credit card. Most people plan to pay it off in January or February. Some do, many do not. Many are still paying for last Christmas when this Christmas arrives. And the Christmas before that is still sitting somewhere in the balance too, buried under new spending, generating interest quietly every single day. The credit card company loves Christmas. Not because people are generous, because January minimum payments are very predictable and very profitable. Or think about the last time your car broke down unexpectedly. The garage said it would be $900 to fix it. You needed the car for work. You had no real choice. But then something else came up the following month and you paid the minimum instead. And then something else the month after that. That $900 car repair, something that happened and was forgotten within a week, could easily still be on your balance 18 months later, having generated over $300 in interest charges by that point. The car is fixed and driving fine. The debt it created is still running. This video is that explanation, all of it. The history of how the credit card was born as a genuine innovation and was quietly transformed into one of the most sophisticated debt generation machines ever constructed. The mathematics of the minimum payment and what it actually means for your financial life over time. The specific legal and political decisions that stripped away the protections that were supposed to stand between you and an industry with an unlimited appetite for your money. Every single fee in the fee structure explained clearly and in full with real scenarios attached to each one. The reward system and an honest accounting of who it works for and who it takes from. The lobbying operation that has kept the rules in the industry's favor for decades. What credit card companies did during the 2008 financial crisis that almost nobody discusses. the data, what they collect from you, what it is worth on the open market, and exactly what they do with it. And finally, what all of it means for your financial future and what you can actually do about it starting today. By the end of this video, you are going to look at that card in your wallet with completely different eyes. And you are going to understand clearly why these companies have spent so much money for so many years, making sure you never had access to exactly what you are about to hear. Let us start at the very beginning. Because the history of the credit card is one of the most fascinating and ultimately one of the most disturbing stories in the entire history of consumer finance. It begins not in a bank, not in a government hearing room, not in a corporate boardroom, but in a restaurant in New York City on an entirely ordinary evening in the year 1949. A businessman named Frank McNamara is having dinner with a group of clients at a restaurant called Major's Cabin Grill in Midtown Manhattan. It is the kind of dinner where impressions matter enormously. Frank McNamara is trying to build relationships, project success, and demonstrate the kind of competence and reliability that wins business. When the meal ends and the bill arrives, he reaches into his jacket pocket to retrieve his wallet and realizes with a sinking feeling that it is not there. He has left it at home. He has no cash. He has nothing to pay with. His wife has to come to the restaurant and settle the bill on his behalf in front of his clients. It is a profoundly embarrassing moment, the kind that stays with you, the kind you replay in your head for days afterward, wondering what they thought of you. But sitting in that restaurant, waiting for his wife, and stewing in the awkwardness of the moment, Frank McNamara has an idea. What if you never needed to carry cash at all? What if there was a single card, just one card in your wallet that worked at restaurants, hotels, shops, and anywhere else you might need to spend money? You would use it throughout the month, and then at the end of the month, you would receive a statement showing everything you had spent, and you would settle the whole thing in one clean transaction. No cash, no fumbling. No forgetting your wallet and being humiliated in front of the people whose opinion mattered most to your career. Frank McNamara spent the following 12 months developing that idea. He identified restaurants willing to participate. He recruited a small number of founding members. He built a simple membership and billing system around it. And then he went back to Major's Cabin Grill exactly 1 year after the wallet incident. He sat down, ordered dinner with his guests, and when the bill arrived, he produced a small cardboard card with his name embossed on it, signed the receipt, and walked out without exchanging any money at all. That card was called the Diners Club card, and it is recognized as the first modern charge card in history. The owner of the restaurant was so stunned by what had just happened that he reportedly kept the card as a souvenir rather than processing it normally. That evening became known in financial circles as the First Supper. A small, humiliating moment in a Midtown Manhattan restaurant in 1949 that set in motion a chain of events that would eventually produce an industry generating over $130 billion in annual revenue from American consumers. Alone. In those early days, the model was clean, simple, and genuinely useful. You spent money during the month, received a statement at the end of it, and paid the full balance when it arrived. There was no interest because there was no balance carried forward, no compounding debt, no trap. The card was a tool of pure convenience. It meant you did not need to carry large amounts of physical cash. It meant your spending was organized and trackable in one place at the end of every month. Merchants embraced it enthusiastically because research quickly showed that customers who were not physically handing over cash spent more freely and more generously. There is something psychologically different about signing a receipt compared to watching banknotes leave your hands. Spending felt less real, more abstract. The inhibition that comes with physically parting with money was reduced, and customers spent more as a result. This observation that separating the moment of purchase from the physical experience of paying reduces spending inhibition became one of the foundational insights that shaped how credit products would be designed, marketed, and refined for the next 70 years. It still shapes them today. Bank of America launched what would eventually become Visa in 1958 under the name Bank AmeriCard. Other major banks developed their own card programs. The industry expanded rapidly through the 1960s and into the 1970s. The customer base grew into the tens of millions. And as it grew, the banks began looking at their data in increasingly granular and sophisticated detail. Patterns were emerging in that data. Patterns that, when their full implications were understood, would permanently change the direction of the entire industry and the financial lives of hundreds of millions of people across the developed world. Drop in the comments, right? Now, do you pay your credit card balance in full every single month, or do you carry a balance forward? Leave your answer below. Keep watching, because what comes next is going to explain a lot about where your money has been disappearing to, whether you fully realized it or not. A significant and growing proportion of customers were not paying their full balance at the end of each month. They were paying part of it and leaving a remaining amount that rolled forward into the next statement period. And when a balance rolled forward, the bank could charge interest on it. The bank started building serious financial models around this behavior. They were asking one specific and extremely consequential question. If the minimum payment, the smallest amount a customer could pay each month without being formally classified as in default, was set at a level low enough that essentially any customer could comfortably afford it every month without financial strain, what would the impact on revenue be across the entire customer base? The answer those models produced was extraordinary. If the minimum was low enough, a large and statistically predictable proportion of customers would pay only the minimum every month. Not because they were reckless or irresponsible, but because they were busy. Because the payment felt manageable. Because nothing about the experience felt urgently wrong. It just felt like a payment among payments. A normal, recurring monthly expense sitting alongside the phone bill and the electricity statement. And because the interest was compounding on the remaining balance every single month, those customers would stay in debt for years, some of them for decades. Paying interest continuously on money they had long since spent on things they had long since consumed, and in many cases long since forgotten about entirely. The debt would outlive the memory of what created it. The bank would collect interest on it the entire time, and the customer would experience none of it as a crisis because none of it ever felt like one. That realization did not trouble anyone in those boardrooms. It became the business model. Imagine you are a young professional in your late 20s. You just moved into your first apartment. You needed furniture, bedding, kitchen equipment, a few appliances, all the things you need when you are starting fresh somewhere new. You put $4,000 on your credit card because it made sense at the time. You planned to pay it off over a few months. But then the car needed work. Then there was a medical bill. Then Christmas came around and there were gifts to buy. And before long, you were just paying the minimum every month because everything else was also a priority. That $4,000 worth of furniture and appliances, things you needed, reasonable purchases, nothing extravagant, will cost you close to $10,000 by the time the balance is fully cleared if you continue paying only the minimum. The sofa you bought for $800 will have cost you somewhere around $2,000. The kitchen table that was $400 will have cost you close to $1,000. That is not a metaphor or an exaggeration. That is the mathematics of compound interest applied to a minimum payment over time. And it is happening right now to millions of people who have no idea it is happening. Now imagine a couple in their 30s who are trying to save for a house deposit. They put their monthly expenses on the card to earn points. Groceries, fuel, subscriptions, the kids' school trips, household supplies. Every month they intend to pay it all off in full, but some months the full balance is a stretch and they end up paying most of it, leaving a couple of $100s behind. A few hundred becomes a few thousand over the course of a year. A few thousand starts generating meaningful interest every month. The points they are earning on their spending are worth approximately 1% of what they spend. The interest they are now paying is 24% on the balance they are carrying. They are spending $240 in interest for every $10 in rewards they earn. The card they thought was working for them has been working against them for months. They just never sat down and compared those two numbers side by side. The minimum payment is one of the most consequential and destructive financial mechanisms introduced to consumers in the 20th century. It was presented to customers as a gesture of flexibility and understanding. Life is unpredictable. Some months are harder than others. Giving customers the option to pay less when they need breathing room is a service, a kindness, a partnership. That is the framing. That is the story that has been told consistently since the minimum payment was first introduced. In reality, it is a mathematically precise debt generation mechanism, and the numbers that prove it are not complicated. They just require someone to actually sit down and calculate them rather than accepting the monthly statement at face value and moving on, which is precisely what the entire system is designed to discourage you from doing. Here is what that calculation looks like with real numbers. You spend $3,000 on your credit card over the course of an ordinary month. Groceries, fuel, bills, a birthday present for a family member. Your statement arrives showing a $3,000 balance and a minimum payment of $75. You pay $75. You move on with your week. At an interest rate of 24%, paying only the minimum on a $3,000 balance will take approximately 14 years to clear completely. 14 years. To pay off 1 month of ordinary household spending. Over those 14 years, the cumulative interest you will pay on top of the original $3,000 is approximately $4,200. The things you bought for $3,000 will cost you $7,200 in total. You will have paid for everything more than twice. And at no point during those 14 years will anything have felt dramatically or obviously wrong. Just a manageable payment arriving on a statement every month. Month after month. For 14 years. While the interest compounded quietly in the background of your financial life, the credit card company calculated all of that before they ever sent you the card. They built their revenue forecasts around exactly this outcome. They optimized the minimum payment to produce it at scale across their entire customer base. And then they marketed the card as a convenience. Make sure you are subscribed and the bell is on, because what comes next explains how the industry made sure the law could never properly interfere with any of this. For most of the 20th century, usury laws existed across the United States to protect consumers from predatory interest rates. Different states had different specific caps, but the principle was consistent and broadly accepted. There is a legal ceiling on how much any lender can charge a borrower for the use of money. These laws existed because societies had understood for centuries that people in financial need are vulnerable to exploitation, and that without legal limits, the most desperate borrowers would accept almost any terms because they felt they had no choice. Usury laws were not a radical idea. They were a widely accepted recognition of a basic and obvious power imbalance between lenders and borrowers. In 1978, the United States Supreme Court ruled on a case called Marquette National Bank versus First of Omaha Service Corporation. The legal question at the center of the case was technical. Which state's laws governed an arrangement where a nationally chartered bank based in one state lent money to a customer living in another? The ruling determined that a nationally chartered bank could apply the interest rate laws of its home state to customers living anywhere in the country, regardless of what those customers' state laws said about maximum permissible interest rates. The logic was narrow and procedural. The consequences were enormous and lasting. The credit card industry read that ruling immediately and understood exactly what it meant. If a bank could choose to headquarter its operations in whichever state offered the most permissive interest rate environment, then the only thing standing between the industry and effectively unlimited interest rates was the willingness of any single state government to relax or eliminate its laws in exchange for the economic benefits of hosting major banking operations, jobs, corporate tax revenue, political relationships, the prospect of becoming the registered home state of a major national financial institution. It was a competition the industry was prepared to help create and to reward generously. Delaware moved first, and it moved deliberately and openly. In 1981, the state of Delaware passed legislation that eliminated its interest rate cap specifically and intentionally to attract credit card issuers. The arrangement between the state and the industry was explicit. Come here, employ our residents, pay your corporate taxes here, and set whatever interest rates your business model requires without legal restriction from this state. Citibank, which had been constrained by New York State's usury laws and was actively looking for a way to increase the margins on its credit card operation, relocated its entire credit card division to Delaware almost immediately after the legislation passed. South Dakota passed equivalent deregulatory legislation around the same time. Other major issuers evaluated the options and followed to one state or the other over the following years. And just like that, the usury law protections that had been a feature of American consumer finance for generations had been effectively neutralized for credit card lending. Not through any single dramatic piece of national legislation, not through any event that made front page news across the country, simply through a Supreme Court ruling, a handful of state-level legislative decisions, and a series of corporate relocations that the vast majority of American consumers never heard about and would not have fully understood the long-term implications of, even if they had. The average credit card interest rate in America was approximately 12% in 1977. By the mid-1980s, it had risen past 17%. By the 1990s, rates above 20% were industry standard and widely accepted as normal. Today, the national average sits at approximately 21% to 24%, and subprime cards routinely carry rates of 29% to 36%. A home mortgage in the current environment costs approximately 6% to 8% annually. A personal loan from a mainstream bank charges between 10% and 15%. The historical long-term average annual return of the broad United States stock market is approximately 10% per year. A credit card is charging more than double the rate that the entire stock market has historically generated as an average annual return over the long term, on money that has already been spent, on things that are already gone and in many cases already forgotten. And the deregulation that made those rates not just possible but standard and broadly uncontested was lobbied for, legislated for, and executed with full and complete understanding of what it would produce for industry profits and what it would cost consumers across the country. Your honest reaction to those numbers, drop it in the comments below. Because what comes next is the part of the story that the industry has consistently worked hardest to keep out of mainstream public conversation. Let us talk about lobbying. Because the legal and regulatory environment that allows credit card companies to charge 24% interest, layer fee upon fee, sell your spending data, and design minimum payments that keep customers in debt for 14 years did not emerge naturally from a free market. It was constructed deliberately and methodically over decades through one of the most sustained, well-resourced, and ultimately successful lobbying operations in the history of American politics. The financial services industry is consistently among the largest spenders on political lobbying in the United States by a very significant margin and has been for many decades. In the period surrounding the 2008 financial crisis, a crisis caused in substantial part by irresponsible and, in some cases, fraudulent lending practices across the financial sector, major banks and credit card issuers spent hundreds of millions of dollars on lobbying efforts directed at members of Congress and at the federal regulatory agencies responsible for overseeing their industry. A significant proportion of that lobbying was directed at preventing, delaying, or substantially weakening legislation that would have restored meaningful consumer protections that the industry had spent years removing or circumventing through regulatory and political channels. The Credit Card Accountability, Responsibility, and Disclosure Act. The CARD Act was passed in 2009 at the moment of peak public anger at the financial industry in the immediate aftermath of the crisis. It introduced clearer disclosure requirements around interest rates and fees, restricted certain practices around retroactive rate increases on existing balances, and placed limits on some fee structures that had been identified as particularly harmful to consumers. It was a genuine legislative improvement over what had existed before it. But the version that ultimately passed was measurably and significantly weaker than what consumer advocates had originally drafted and proposed. Provisions that would have imposed caps on interest rates, restricted fee structures more aggressively, and created stronger enforcement mechanisms with real and meaningful consequences were lobbied out of the bill during the committee and amendment process before the final text reached the floor for a vote. What passed represented not the full protection consumers needed, but the minimum protection the industry had calculated. It could no longer prevent without risking something worse from a political environment that was at that specific moment unusually hostile to the financial sector. When the Consumer Financial Protection Bureau in more recent years proposed capping credit card late fees at $8, reducing them from the current industry standard maximum of $41. The response from the credit card industry was immediate, forceful, and extremely well-funded. Lobbying campaigns were launched in Washington. Legal challenges were filed in federal court arguing that the Bureau had exceeded its statutory authority. Industry spokespeople and trade associations argued publicly and repeatedly that capping late fees would restrict access to credit for lower-income consumers who most depended on it. Consumer advocates describe this framing as a deliberate and cynical misdirection from a straightforward reality. American consumers pay approximately $12 billion in credit card late fees every single year. $12 billion charged to people, often people already in difficult financial circumstances, for being one day late on a payment. The proposed cap faced sustained legal challenges. Its implementation was delayed. The $12 billion continued flowing into industry accounts while the litigation proceeded through the courts. Now let us talk about what happened during the 2008 financial crisis. Because what credit card companies did during that period is one of the most important and one of the least discussed chapters in this entire story. When the housing market collapsed and millions of Americans lost their jobs, their savings, and their homes simultaneously, the credit card industry did not respond with patience, understanding, or any gesture of partnership with the customers who had been paying them interest for years. It responded by accelerating extraction from the people who could least afford it at the precise moment they were most vulnerable. In the months leading up to and immediately following the crash, major credit card issuers engaged in a practice that became widely known as rate jacking. Banks reviewed their customer portfolios and unilaterally raised interest rates on existing balances, not on new purchases going forward, not on future borrowing, but on money customers had already borrowed under a different agreement at a different and lower rate. A customer who had been carefully managing a balance at 14% for several years received a letter in the post informing them that their interest rate was being increased to 24% or 29% effective immediately. The balance had not changed, the customer had not missed a single payment, their credit record was clean. The bank had simply decided to reprice existing debt upward because the regulatory environment at that time allowed them to do it and because the financial circumstances of the moment made it profitable to do so. Think about what that meant for real people in real households. Someone had been managing a $6,000 balance on their credit card for 2 years, paying on time every single month, never missing a payment, never going over their limit. Then they lost their job in the crash. They were already under severe financial stress. They were trying to figure out how to cover their mortgage, their groceries, and their children's needs on reduced income while searching for new work. Then they opened a letter from their bank informing them that the interest rate on that $6,000 balance was increasing from 15% to 27%, effective immediately. Their monthly interest charge jumped by nearly $60 per month on a balance they had been managing responsibly for 2 years at the worst possible financial moment of their lives, with the least possible ability to pay the balance off and escape the higher rate. This was not an isolated case affecting a small number of customers. It happened to millions of Americans simultaneously during the same period. The public justification offered by the industry was risk management. The economic environment had deteriorated significantly. The statistical risk profile of their overall customer base had changed as unemployment rose. Adjusting rates was a prudent and necessary response to genuinely changed conditions. What was not said publicly was that this practice was generating substantial additional revenue from the most financially stressed segment of their customer base at the precise moment when those customers had the fewest options to respond to it. Congressional hearings were held. Executives from major credit card companies were called to testify before committees. Several members of Congress described what they were hearing in terms that were notably direct and pointed for a formal hearing environment. The testimony and documentary evidence produced by those hearings is publicly available in the congressional record, and it is a remarkable and detailed education in the gap between how the industry describes its own behavior in public communications and what the documented evidence from internal communications and customer records showed it was actually doing. The CARD Act restrictions on retroactive rate increases that were included in the 2009 legislation were a direct and specific response to what those hearings uncovered and documented. They were also, as previously noted, weaker than what advocates had originally proposed. The rate jacking largely stopped after the legislation passed. The underlying appetite for revenue extraction from financially stressed customers did not. Now let us go through the fee structure in complete detail. Because interest is only the first and most visible layer of how these companies extract money from their customers. Underneath the headline interest rate, there is an entire carefully designed architecture of additional charges, most of which are designed to be invisible or forgettable until they appear on your statement, and several of which compound each other in ways that accelerate debt accumulation significantly faster than most customers ever anticipate. Late payment fees are charged when you miss your payment due date by any amount of time. 1 day late. The current regulatory maximum is $41, and most major issuers charge at or very close to that maximum because there is no competitive incentive to charge less when every major competitor is operating near the same ceiling. The $41 appears on your next statement on top of whatever interest is already accruing on your balance, but the immediate fee is only the beginning of what a single late payment can cost you. Missing a payment can trigger a penalty APR, a higher interest rate that activates automatically under the terms of most credit card agreements, and that can reach as high as 29.99% annually. Many card agreements specify that the penalty APR applies not only to new purchases made after the missed payment, but to the entire existing balance retroactively from the date of the missed payment. You were 1 day late. The interest rate on every dollar you currently owe just jumped to approximately 30% per year, and it will remain elevated until you have made a specified number of consecutive on-time payments before your rate is reviewed for possible reduction. Usually that means 6 months of perfect payments before you can even apply to have the penalty rate removed. Think about what that means practically. You have been managing a $5,000 balance at 19% for 6 months, paying on time every single month without fail. Then 1 month you forget, not because you do not have the money to pay it, just because life was busy and you forgot to log into the app, one missed payment, one letter in the post, and suddenly the interest rate on that entire $5,000 balance is 29.99%. Your monthly interest charge has gone from approximately $79 to approximately $125 per month, an increase of $46 every month for forgetting once. That is the system working exactly as it was designed to work. Cash advance fees apply every time you use your credit card to withdraw cash from an ATM or transfer money directly to a bank account. The fee is typically between 3% and 5% of the total amount being withdrawn, and it is charged in full immediately at the point of the transaction. On top of that, immediate fee cash advances carry a higher ongoing interest rate than regular purchases, usually sitting between 25% and 29% annually. And unlike regular purchase transactions where there is a grace period between when the purchase is made and when interest begins to accumulate, cash advance interest begins accruing from the precise moment the cash is dispensed. Not from the end of the statement period, not from the payment due date, from the moment of withdrawal itself. Every hour that passes from that point, the debt is growing. Many people who have used their credit card at an ATM during a tight month have no idea that the interest started accumulating the same day they took the money out. Foreign transaction fees appear on every purchase made in a foreign currency or processed through a foreign financial institution, between 1% and 3% per transaction. This sounds trivial in isolation. On a 2-week international trip with regular daily spending across accommodation, meals, transport, activities, and incidental purchases, the cumulative total becomes genuinely significant. Many people have been paying these fees for years without ever noticing the individual line items on their statements or connecting them to the specific purchases that triggered them. Balance transfer fees are embedded within the 0% promotional offers that credit card companies market aggressively and persistently across digital advertising, direct mail campaigns, and pre-approval letters. The offer sounds unambiguously beneficial. Move your existing debt to this card, pay 0 interest for 12 or 15 months. Use that time to clear the balance without the interest working against you every month. What the promotional headline never prominently states, and what the terms and conditions eventually disclose, is the balance transfer fee of between 3% and 5% of the total amount being transferred, charged upfront and in full on the day the transfer is processed. On a $5,000 balance being transferred, that is $250 paid immediately before a single dollar of interest saving has been achieved. And if the transferred balance is not fully cleared before the promotional period ends, the standard interest rate that activates is frequently higher than the rate on the card you transferred from. The promotional offer was engineered to acquire your balance. What happens in month 13 when the promotional period expires and the full rate kicks in on whatever is left is where the profit lives. Annual fees on premium credit cards range from approximately $95 at the entry level to $695 or more at the very top of the premium tier from the most prestigious issuers. The marketing pitch for every premium card is constructed around the total value of included benefits, airport, lounge access, annual travel credits, comprehensive travel insurance, purchase protection, concierge services, dining credits, hotel status upgrades, and more. The pitch is always that using the included benefits intelligently makes the card pay for itself many times over. For a specific and narrow subset of cardholders, high-frequency business travelers who spend significant portions of their working lives in airports and who consistently activate and use every available benefit, this calculation can genuinely be accurate. For the majority of cardholders paying premium annual fees, a substantial proportion of the included benefits go unused or only partially used. The credit card company has access to precise data on exactly what proportion of their cardholders use each individual benefit. They price the annual fee with full and detailed knowledge of actual utilization rates across their customer base. The fee is set to maximize revenue given known usage patterns, not to reflect the value that most cardholders actually extract from what they are paying for. Has this changed how you are thinking about your credit card right now? Tell me in the comments below. And if you know someone who carries a monthly balance on their card, share this video with them, because what comes next is the layer of this system that is most carefully concealed from public view. The reward system is where card companies demonstrate the full depth of their understanding of consumer psychology and the full extent of what they are prepared to do with that understanding at scale. The introduction of cashback programs, airline miles, and hotel point systems in the 1980s was one of the most consequential strategic decisions in the history of consumer finance. Not because the rewards themselves were particularly generous, but because of the psychological transformation they produced in the relationship between cardholders and their cards. Before rewards, a credit card was a neutral payment tool, useful but essentially emotionless. After rewards, it became something you felt actively positive about using, something that rewarded your engagement, something that felt like it was working for you with every single swipe. The card went from a product you used to a product you had a relationship with and a preference for. The psychological transformation was enormous, and it was entirely deliberate. When you make any purchase with your credit card, the merchant on the other side of the transaction pays a processing fee to the card network for handling the payment. This is the interchange fee, and it sits between 1.5% and 3.5% of the total transaction value. It is paid on every single transaction made with a credit card at that merchant. Because merchants cannot generally identify individual customers and charge them differently based on payment method, they build the cost of interchange into the prices they charge everyone. Every customer, including people who pay with cash, including people who pay with debit cards, including people who have never owned a credit card in their lives and who never see any of the rewards that their spending is partially funding. Every consumer is effectively subsidizing the reward system through the prices they pay for goods and services every day without knowing it and without ever having agreed to it. The rewards you receive are funded by a combination of the interchange fee and the interest paid by customers who carry balances. The rewards are real, but their cost is distributed across all consumers and concentrated most heavily on the people least able to bear it. People who carry balances pay far more in interest than they ever receive back in rewards. They are net losers in the system even as they accumulate points on their purchases and feel like active participants in a benefits program. People who pay cash contribute to a system they do not participate in through the prices they pay for everything they buy. And the people who receive genuine net positive value from the reward system are overwhelmingly those who pay their full balance every month and never pay interest. These tend to be the people with the highest and most stable household incomes. The reward system is in its structure and in its effects a large-scale and continuous transfer of money from lower-income consumers to higher-income ones. It accomplishes this invisibly, automatically, and at a scale that most people would find extraordinary if it were ever laid out plainly and directly in front of them. Your credit score is the number that determines what almost everything in your financial life costs. You, your mortgage rate, your car loan rate, your personal loan interest rate, your next credit card rate. In some states, even your insurance premiums are influenced by it. A high score means lower rates across all of these products throughout your financial life. A low score means higher rates on all of them, which means that people who begin their adult financial lives with disadvantage, fewer resources, less margin for error, less access to the kind of financial education and guidance that helps people avoid the specific mistakes that damage credit scores pay more for every financial product they ever access throughout their entire lives. The gap compounds over decades. The initial disadvantage grows rather than diminishes, and no individual decision maker had to choose to cause it. It runs automatically, built into the architecture of a system designed and lobbied into existence by the institutions that benefit from it most consistently. And through all of this, your credit card company is collecting data. Every transaction is a data point, and every data point tells them something precise and useful about your life, your habits, your priorities, and your financial vulnerabilities. They know where you shop for groceries and how much you typically spend. They know how often you fill your car with fuel. They know when you eat at restaurants and at what price points. They know whether your spending this month is materially higher or lower than your typical monthly pattern. And they have sophisticated models that interpret what that deviation is likely to mean. They know, with considerable statistical confidence, when you are likely to be going through a financial or life transition, a job change, a home purchase, a relationship change, a new baby, a period of elevated financial stress, and when those transitions make you most likely to be receptive to a new credit product, a limit increase, or a balance transfer offer. Think about that in practical terms. You recently started spending significantly more at baby retailers. A cot, a pushchair, nappies, formula, baby clothes. You have not announced anything publicly, but the data algorithms at your credit card company flag the pattern change within weeks. You have been placed into a new customer segment. The offers and communications coming your way will shift to reflect your new life circumstances before you have even thought about telling anyone else. That is not coincidence or good timing. That is the data operation running as intended using your own spending behavior to identify and target you with precision at a moment of maximum receptiveness. This data is used internally to shape and personalize every offer and communication directed at you individually. And aggregated versions of it are sold to retailers, market research firms, advertisers, and other financial institutions as a completely separate and significant revenue stream. Your spending behavior is a product. It is packaged, priced, and sold without most cardholders ever knowing it happens, ever seeing the terms that permit it, or ever receiving any share of the revenue it generates. Here is the honest reality, and it is important to be direct about it. Credit cards used in a disciplined way, paid in full every single month without exception, never carrying a balance forward, can be genuinely useful financial tools. The fraud protection that credit cards provide is real, meaningful, and significantly stronger than what is available with most debit cards or cash transactions. The consumer rights when a purchase goes wrong are more robust. The convenience is real. The rewards for people who never carry a balance can deliver genuine net value over time. For people who operate with complete consistency and who have the income stability to always pay the full balance, the system can work in their favor. The problem is that the entire ecosystem surrounding the card is engineered to make disciplined use as difficult and as uncommon as possible. Because disciplined use does not generate $130 billion in annual revenue. The minimum payment encourages balance carrying. The interest compounds daily rather than monthly in most card agreements. The fees activate at the first sign of financial imperfection. The penalty rates jump the entire balance to 30% after a single missed payment. The rewards psychology is designed to drive more spending. The marketing consistently associates the card with freedom, aspiration, and reward rather than with debt, interest, and extraction. The lobbying keeps the regulations as weak as the industry can arrange. All of it working together, all of it pointed in the same direction. What can you actually do about all of this starting today? First, if you carry a balance right now, work out the exact amount you are paying in interest every single month. Not the minimum payment total, just the interest portion of it. That number is the true cost of your current situation. Write it down, look at it. Many people have never done this, and the number surprises them. Second, if you can redirect any amount of additional money above the minimum payment toward clearing the balance, do it consistently. Even an extra $50 or $75 per month above the minimum makes a measurable and significant difference to how quickly the balance clears and how much total interest you pay. Third, if you are considering a 0% balance transfer offer, calculate the transfer fee on day one and compare it honestly against the interest you would actually save over the promotional period before assuming it is automatically a good deal. Fourth, if you are paying an annual fee on a premium card, sit down and add up every benefit you actually used in the last 12 months, not the benefits available, the ones you actually activated and used, and compare that honest total to what you paid. The calculation is almost always surprising. The average person carrying a credit card balance pays over $1,000 per year in interest. Take that same $1,000, instead of paying it to a financial institution every year, invest it in a broad market index fund generating the historical average annual return of approximately 10% per year. Do that every year for 30 years. That $1,000 per year becomes approximately $180,000 in accumulated wealth. The difference between carrying a credit card balance for 30 years and investing that same money instead is not $30,000, it is $180,000 gone from your household. Transferred to a financial institution, legally, quietly, one minimum payment at a time, for 30 years. While the statement kept arriving every month and the payment kept feeling manageable and nothing ever felt urgently or obviously wrong, the credit card company does not want you running that calculation. They want you focused on the cashback points you earned on your last grocery shop, next time pulling apart another company, and what they have built to separate you from your money makes everything covered today look almost straightforward by comparison. You are going to want to be there for that one. If this video made you look at your next credit card statement differently, subscribe and hit the bell. New videos every Monday, Wednesday, and Friday. And every single video on this channel is going to give you something these companies were hoping you would never find out.